All right, let's talk about self-managed super fund buying property for investment. So today we're going to tackle the structure that's actually required for a self-managed super fund to invest in property. And there's a few entities that are required. The first thing you need, and it's in the name, is a self-managed super fund, which is a trust, a special purpose trust, but a trust. Every trust needs a trustee. The trustee is the person or the people or the entity that is going to make the decision for the trust. In this instance, we recommend that you use a corporate trustee, which is a company, and that company is going to have directors. Those directors are going to be the people making the call. In the case of self-managed super fund, they can be up to 4 people in charge. So you can have up to 4 members. And what it's going to look like is like this. So that's member 1 to member 4. It could be 1, it could be 2, it could be 3, it doesn't matter. The people that are going to be in charge of that self-managed super fund by law must also be the people that are going to benefit from the fund. So they're going to be the members, the people that the money is going to flow to in the end. That's your self-managed super fund. Okay, so once we've done that, we get an ABN, we get a tax file number from the tax office, and that fund is ready to operate. The first thing that we're going to do with that fund is organize the rollover. So the money that the members have accumulated in their respective superannuation funds to date can be rolled over into that self-managed super. All of it or some of it can be rolled into that self-managed super fund. So for the sake of the example, let's assume that we're rolling in $200,000 from the members' existing superannuation fund. For all intent and purposes, that is for all investments that do not require the super fund to borrow money, then this is the structure we're going to use. So that super fund is ready to purchase a property cash if there's enough money in the account. It's ready to buy shares, it's ready to buy precious metals, it's ready to buy collectibles, it's ready to buy whatever it is that the self-managed super fund trustee want to invest in, as long as there's not going to be a loan required to actually purchase those assets. In the case of property, more often than not, trustees will want to leverage, and leverage is borrowing money to buy that asset, to buy that property. In order to do that, we're going to need to have that asset, the property, the title, to sit outside of the self-managed super fund. And the reason for that is the legislation. The legislation will not allow a self-managed super fund to hold an asset which has a debt against it. And that's to protect the self-managed super fund against recourse from the bank. So if the debt on the property goes bad and the bank wants to recourse on that property, they cannot touch the other assets that are in the self-managed super fund. The way we achieve that is by creating an additional holding structure. And what the new trust with its own corporate trustee is going to do is one thing and one thing only, and that is to hold the asset on behalf of the self-managed super fund until the debt is paid off. That's all it does. No trading, no tax return, no audit, no anything. It's just a holding structure. And that's how we can purchase a property using a loan for a self-managed super fund.